is not only a health impact, it's got long-term economic effects. And we're going to discuss these impacts on the funds when it comes to the effect on rates, low interest rates for a long time potentially to come, the impact on investment returns, the community and the confidence in the future. And I guess all this leads to uncertainty, however you look at it. So let me turn to Karin first. If you could possibly give us an overview of the global investment trends, the general landscape for pension funds globally to set the scene.
Thank you. Can you hear me well?
Yes.
Yes. So the overall investment for pension funds is about the total number of assets is about $70 trillion. That's $70,000 billion, and that represents about half of the assets managed by asset owners. It's a significant share in the world, and what's specific about pension funds is that they are invested for the long term. One item that I think is very interesting when I look at those trends on pension funds is that public pension funds are very different from corporate pension funds. I think the corporate pension funds are driven by the specifics of their sponsor and their needs to show solvency on a short-term basis. Public pension funds have really a very long-term nature, and they can really invest for the long term, which I think is quite interesting. And what we see in terms of generic trends on investment is that really the difference of public pension funds is that they invest in, they have changed their investment style to more risky assets because of the low interest rates. And so we have seen a very strong increase, a 17 percentage point increase in alternatives over the last 20 years. So alternatives now for public pension funds represent about 23% of the overall investment, which again is 17% more than it was in 1999. And this is related to the fact that public pension funds can take the volatility risk, can take the liquidity risk involved in investing in alternatives. I would say also that a trend that is important for pension funds, for public pension funds in the world, is the shift towards ESG. I don't know that in the region it's necessarily yet at top of mind for public pension funds, but for European, Canadian, Australian pension funds, that's a trend that I think we will discuss a little bit more. And then the last trend that I think important, that is not really investment, that's about the tools around investment. It's the organizational IT challenge that we've seen with pension funds who have very often a heavy reliance on spreadsheets and are interested in potentially pooling their assets with other pension funds so that they can face those challenges from an infrastructure point of view, from a cost of trading point of view. And so I think this is also a very interesting trend. So 3 trends: more risk, more ESG, and more investment from an infrastructure point of view, potentially leading towards consolidation.
Thank you, Karin. Ms. Kholoud, maybe you could touch a little bit on the general structure of the fund and the Social Security Investment Fund, maybe the history and really asset allocation, and how COVID has impacted the way you look at the world.
Yes, good morning all. And at the beginning, I want to extend my deepest condolences to the Bahraini leadership and people over the passing of Prime Minister Prince Khalifa bin Salman Al Khalifa. May his soul rest in peace. I would also like to thank FinTech Robos for this great opportunity to be with you today, and I look forward to our discussion. As you all know, the COVID-19 pandemic has caused significant disruption and hardship in nearly every aspect of our lives, and it continues to weigh heavily on our national economy. Today, I'm going to brief you quickly about the Jordanian Social Security Investment Fund, SSIF, its history, asset allocation, and the pandemic impact, as Farah Ms. Farah requested. SSIF was established in 2003 as the independent investment arm of the Social Security Corporation with total assets of $2.4 billion. Today, after 17 years of operational, institutional, and investment experience and exceptionally long horizon, our portfolio reached $15.5 billion, all invested locally, which compromises now more than 30% of the Jordanian GDP. And all this helped the SSIF to become the largest investment house in the country and ranks among the biggest in the region. A quick glance on our portfolio, we see that SSIF investments are well diversified among several portfolio sectors and instruments. While 2/3 of our portfolio is invested in short and medium-term government bonds and bank deposits, which is considered low risk and safe to ensure sustainability and liquidity. The rest of the portfolio is invested in strategic investment tools such as equities and real estate. SSIF focuses on the development side without competing or undermining the private sector. In fact, we try to serve as a catalyst and a complementary, reliable, long-term partner for the private sector. As a fund with a significant buffer and quite long-term liabilities, our investment policy has been focusing on key market roles. The first one is developing new markets. Throughout the fund's life, many partnerships were established and created into untapped markets. The fund has partnered with world-class real estate in many cities. The fund owns a chain of 5 and 4 stars hotels scattered all over the country. In addition, the fund has contributed to enhance the term structure of the capital market instruments through encouraging the government to issue long-term bonds, as the private sector interest was only in short and medium term. We also, as a fund, perform a counter-cyclical role in the economy, and we don't crowd out with private sector investment during boom time, while we play an active role during bust. And SSIF practices the PPP model for many years. It has partnerships with the government and the public sector to finance many major and vital infrastructure projects such as hospitals, schools, and railways. And now I will shift to tell you about the pandemic impact. SSIF usually, as I said, address investors and government. COVID-19 uncovered the need for addressing a wider range of stakeholders, from the social security contributors, pensioners, due to the socio-economic nature of our entity. This pandemic placed us at the epicenter of the crisis. We had a major economic as well as social role to play. Our weight was certainly felt throughout the economy and in almost every household of the Jordanian community. The social media enabled us to timely reach the Jordanian citizens to reassure them, serve them, and keep them well informed. We found ourselves in an unusual state of being, and we depended on brainstorming collectively. We were all overwhelmed, exactly like the experience of being thrown into a pool for the first time without being sure about our swimming skills. Analysis and paralysis dominated, and our objective was to try to find the best solution at once. SSIF well-diversified portfolio has mitigated the negative impact of the unprecedented challenges that COVID-19 had on the economy. We were fortunate to find ourselves a bit ahead of the curve due to this diversification and having a significant cash cushion as part of our portfolio. This prudent policy supported the Social Security Corporation in initiating and launching its social protection programs. It's worth noting that Social Security Corporation always transferred funds to SSIF. Now, the situation was not just reversed, but completely frozen, We needed to transfer major amounts of funds back to SSC to enable the corporation to meet its newly formed obligations that resulted from the initiated social protection programs. Furthermore, the Social Security Corporation extended an emergency loan program for certain segments of the retirees, which was also funded by SSIF. This pandemic made us more confident and certain about our investment policy statement and emphasized further investment into infrastructure, health, and pharmaceutical sectors. We were ahead of the situation in this as well, as major infrastructure investments in the health sector and the green energy and the pharmaceuticals were already part of our investment portfolio, since the investment in these sectors has been thoroughly expanded during the past 3 years. The new addition came to the agricultural sector as we recently initiated a major agricultural investment. One noteworthy intervention that comes to my mind now is our considerate response towards our real estate tenants as a decision was taken to grant them deferment. Furthermore, multifaceted financial contributions were undertaken on different fronts and for different durations towards the National Solidarity Account Himmat Watan. Different kinds of contributions and payroll deductions came from the SSIF Investment Board and the investment directors and senior staff. Throughout the pandemic, we continued to be in action to serve the Jordanian citizens without compromising the well-being of our employees, as well as the importance of equipping them with ICT tools and to ensure a safe distance working when needed. In short, it was a time of coming together for the best interest of the entire Jordanian population, be it the employer, the employee, or the beneficiaries. At last, I cannot highlight enough the importance of being surrounded by the right responsive team who didn't spare any effort to rise up the situation caused by the pandemic. And thank you for giving me this opportunity to share our experience. And I look forward to hearing the important lessons learned from the rest of the esteemed panelists. Thank you. Thank you.
Thank you very much. Let me jump now to Mr. Abdulatif Alseif. So you've heard both Ms. Kholoud and Karin talk about the increase of risk, the increase in alternative investments, potentially infrastructure. How have you, as a fund, been able to maneuver or reposition if it was needed at all? And how are you looking to achieve returns in this low interest rate environment?
Sure. Well, first of all, thank you for inviting me to participate in this wonderful conference. I always enjoy participating and attending it every year, although this year virtually, but hopefully next year will be physical, joining everybody in Bahrain. So as to the pension plan that we manage, of course, when we look at the next decade, we're looking at the capital market assumptions and what can be obtained from the various asset classes in terms of return. And this time around, when we looked at our strategic asset allocation and how should we reposition the portfolio, it was interesting to reflect on the past decade and how did markets behave during that period. And if you remember, over the last 10 years, we started right after the great financial crisis, where we thought we had increasing levels of debt globally. We thought that the world will be living in a stimulus from fiscal and monetary policymakers, and the ramifications on financial markets we believe to be significant and might impact returns. Well, what happened is, of course, we all of us enjoyed good returns over the past decade, supported by huge rally in equities, decent returns from fixed income that saw a collapse in yields and reasonable spreads on credit. And we saw alternative assets also performing well during that period of time. So looking at where we are today, makes us realize that the next decade might be different than the past. One big difference is that the starting point is different. Right now, we see elevated levels of valuations in equity markets. We see a collapse in yields. Interest rates are almost zero globally. And then there are many treasuries or many fixed income instruments that are negative yielding also in some parts of the world. So the question is, where are we going to get from here over the next 5 to 10 years? And obviously, one can shape many scenarios, but in whatever scenario you look at, the returns probably will be lower than what we're used to in the past. For example, we modeled a pure 60-40 portfolio over the next decade, given the average return assumptions by market participants in the market, and we realized that a 60-40 probably will have a return of around 4% over the next decade or so. And the reason is you are starting with almost zero interest rates, and probably that will be increasing, eating some of the coupons that investors will enjoy. Equity returns might be a bit lower than what we are used to in the past. And the only exception is, of course, if we see a significant increase in growth over the next decade that will justify the higher valuations we live in. And so we, like many investors, are looking at a wider spectrum of assets to see where can we obtain returns from. Naturally, we're looking at various parts of the credit space. We're looking at EM credit. We are looking at leveraged loans. We're looking at private debt and other instruments that might provide some yield over the next cycle. We're also looking at alternatives and looking at private equity, especially, and infrastructure and other types of assets that might still provide reasonable returns over the next decade or so. So these are assets that we are increasing focus on in order to enhance the return that one would normally obtain by a 60-40 portfolio. At the same time, we are looking at various strategies that will enhance the returns. For example, we are revisiting the active versus passive exposures that we had in the past. In the past, we focused a lot on passive exposures that have done us extremely well and have been able to provide us with good returns at minimal fees. Now, with the huge volatility we see in markets, the dispersions of returns among stocks and sectors alike, we realize that active management might have a chance, and a good manager that is able to capture the themes and the valuations in the different stock markets might be able to generate some alpha that will enhance the overall return of any pension. We are also looking at various strategies, mostly quantitative and smart beta strategies that provide hopefully a diversified way of capturing exposures to the various factors in a cheap and efficient manner. So definitely what we will see in the next decade will be different than what we saw in the past decade, and it will require more active management, maybe increasing of risk taking, but also requires higher risk management at all times. It requires more sophisticated tools to be applied in order to ensure that one is investing wisely and is able to capture what is intended to capture in the various segments of the market.
Thank you very much. Philippos, now let me turn to you now from a slightly different angle. We've heard about the investment challenges and the challenges with asset allocation and achieving the returns. A 4% return with a 60-40 model is going to be maybe potentially tough to reach some of these funding gaps globally. What kind of solutions are there, or do you want to touch on maybe the mounting liability gaps around the world and the aging population, and what should pension funds be doing or looking at?
Thank you, Farah. Let me start by thanking Ibrahim for the invitation and congratulations for this initiative. I will try to start by linking yesterday's discussions on the financial sustainability challenges that relate to the underlying liability structures with a common myth when it comes to investment. So there is undue pressure on investment teams and investment committees by policymakers, and there is a false pretext that investment success will solve all the challenges that we've heard yesterday. And this is a myth, and it needs to be very clear that it is almost impossible for any investment strategy to deliver the required returns that are needed to solve the financial sustainability challenge. However, when coupled with some of the parametric reforms, the investment success can have a huge impact. And the purpose of a successful investment program is to assist exactly that, to reduce the impact of sudden changes to the program parameters and to smooth out any intended reforms over long transition periods so that any impact is gradualized over successive cohorts of the population. Now, Abdulatif has very accurately captured the expectations for the next 10 years. The expected returns across all asset classes, all traditional asset classes, are reduced compared to what we've seen in the last decades. And we have seen a shift in public sector funds when it comes to their asset allocation to alternatives. But there was a first wave, if I can go back a few years to the Middle East public sector funds. Firstly, there was a shift from the home bias. Most of these funds were largely invested domestically. And there was first a wave of globally diversifying their portfolios to capture the global opportunity set. And in the last 5 to 10 years, we've seen an increased shift to alternatives. Karin has accurately said that the global public sector funds allocate slightly above 20% to alternatives and illiquids. According to the data we have, the Middle East public sector funds allocate a bit less, around 11% to illiquids. This is an average, of course. Some exceptions do exist in the Middle East, but compared to the global trends, there is still some room as far as illiquids are concerned. And this is where we see a trend in asset allocation decisions in the coming years. Illiquids, however, come with a wide opportunity set. If I could categorize illiquids in 4 buckets, that would be real estate, private equity, private debt, and infrastructure. And the challenge with illiquids compared to some of the public market strategies is that returns come with wide dispersion. And wide dispersion means that you need to be very nimble and very careful as to how you select your asset managers and your investments. And you need to improve the level of governance and oversight in order to effectively and efficiently implement strategies within those asset classes. Now, we do believe that allocations to private markets possess natural advantages over traditional asset classes, and they are very suitable for long-term investors like public sector pension funds. However, these come with increased tolerance in illiquidity and complexity, which, as I mentioned, required different levels of governance and oversight in order to be able to implement this effectively and efficiently. Increase in illiquidity, however, comes with challenges. Each fund has a unique profile when it comes to its underlying cash flow requirements. So each fund has a different liquidity profile, and they need to very carefully assess any significant increases in illiquidity that relate to these exposures.
Thank you.
That's all I wanted to say so far. Farouk, I'm happy to take any questions during the discussion. Thank you.
Thank you. I think we may actually be now just on time to have polling questions. I think there are 2 polling questions that are coming through from our hosts. Is that correct? Or are we not ready? Here we go. The assets of government pension funds are managed very well in the MENA region. Are the hosts going to tell us when we have enough answers? It's a little bit of an open question. I think we have a few more seconds of taking answers. So when we're ready, we'll move to the second question when we've collected enough answers. Are we moving to the second question? Are we ready to move to the next question? Or are we going to get results? I'm not sure if anyone is, well, I think the poll is still in progress. I think we're waiting for. Okay. So it feels like our audience does not have a lot of confidence in how pension funds are managed in the region. The assets of pension funds should invest more locally versus internationally in the region to create jobs. I think the answers touch on some of the questions that are coming through. So one of the questions that's coming through is, has the asset allocation in the past led to potential underfunding of some of these funds in the current state? Does anybody want to take this question? Has asset allocation over the last 10 years affected the ability for some of these the pensions to be underfunded in the region?
If I can start, I think the answer is no. Most of these funds, and not just in the region, but globally, were never intended to be fully funded. They are either funded on a pay-as-you-go basis or by creating some partial reserves. So the intention was never to fully fund the implicit debt relating to the pension promises, which in many cases can exceed 100% of the GDP. So the key driver in the financial sustainability challenges and the implicit pension deficits is the changing demographics. This is the key driver in what we're seeing in most of the pension funds in the region. And asset allocation, as I mentioned earlier in my introduction, can only serve in order to create enough buffer to smooth out any changes and any reforms over a longer period. The asset allocation and the investment success or failure will not change the outlook when it comes to the liability burden, because the demographics are overweighing any other parameter in these systems.
Okay, thank you. Abdulatif, I'm going to turn to you on the role of technology. How has technology helped or been a challenge, and how will it potentially change the way you operate going forward?
Sure. That's a very good question, very relevant at this time. Obviously, when institutions look at their operations and they're putting in place contingencies and protocols to ensure the continuity of business and that they do have the right backups and connectivity to ensure that there are no disruptions to business, they were basically getting ready for a situation like the one we are living in today. And although the situation was very significant, I think that technology have supported many institutions in order to carry out their businesses in a very smooth fashion. Some businesses might have been more ready than others, yet I think the availability of technology to all has enabled most businesses to go through this experience in a rather smooth manner. For us, for example, we did have all the technologies required to ensure that our staff members can conduct their business regularly without any interruptions. We ensured that everybody had the right connections to the systems that we have, connections to each other, right communication channels, right equipment, software, hardware, redundancies, and etc. And that enabled us to carry out our business in a very smooth fashion and without any interruption to business. In fact, we've done things that we never expected to do in the past, which is to do due diligence, to do more investments with managers, and all of that has been done remotely. In the past, we thought that any investments would require physical meetings, physical attendance, to go and do all the checks to ensure that the investments are reasonable and that the operational aspects of things are there. Yet technology has proven to us that everything can be done remotely. Although there are hiccups here and there, probably physical meetings are better at some things, to enhance maybe the understanding of some things. Yet I think the technology we have today will enable us to conduct more business remotely and without the require of travel or visits, which means that we hope that we'll be more productive and more efficient in doing our businesses.
Does that mean you don't want us to come to Saudi Arabia anymore?
No, of course, these are important, but rather than maybe have physical meetings of various times, one can do more virtual and less physical. But I think the physical meetings will continue to be there, but maybe not in the number that we are used to in the past.
Yeah, and I think this event is testament to bringing a lot of expertise from around the world together on a Zoom call for the panelists.
Absolutely.
So one of the questions, and maybe Karin, I will direct this towards you, is the anticipated, are inflation rates expected to stabilize, or are we going to move into some deflationary environment with these low interest rates and depressed economic growth? And maybe how does that relate to the short-term and long-term impacts potentially on asset allocation from the pandemic?
It's definitely a very interesting question. Actually, inflation has never been as exciting, I think, in the last 10 years because we really have uncertainty. I think everyone agreed that inflation was going to remain very low, very stable, in the past. And today we're in this environment where there's this massive influx of flows from central banks in the system. But inflation today is the key figures, the headline figures are slightly negative, which is really related to the current recession that we're living through. Our base case for inflation is that inflation will remain stable, that central banks will have a good grasp on inflation and will control the long-term inflation as expected and as targeted. That being said, and where things get excited is that when we look at our best and worst case, actually, we have very different inflation assumption, and they're the ones who drive our scenarios. We do have a deflationary scenario that would be related to a crisis that would be more, that would be long-term in nature, would be related to the delay in getting the vaccines in place, and the impact on the economy being stronger than expected. So in this case, we're talking about deflation. And when I have clients who ask us, well, how do we deal with deflationary environment? How do we hedge ourselves against this negative scenario? It's actually really difficult. There's no place to hide in a deflationary environment. Of course, fixed income can provide some hedges, but over the long term, a pension fund will need to invest in risky assets. So here we really recommend to be very cautious and look at good long-term investments, such as, for example, infrastructure, which should benefit from the projects that governments are leading. And if looking at equities or credits, with companies with very strong balance sheets, good value, even in a deflationary environment. But the other side of the coin is that if then business starts to get going. There may be actually an acceleration in velocity of money with increase in inflation. And so the other side of this risk scenario is a high inflationary scenario, which again could take place. Although again, our middle scenario, our central scenario, is the one where inflation remains relatively stable. That being said, when I'm talking about a higher or lower inflation in this central scenario, we are not talking about inflation going back to the 70s. We're talking about inflation slightly above the target inflation from central banks, or slightly below the inflation target. So just keeping this in mind of where inflation stands.
Maybe Karin, if I sorry, go ahead.
Yeah, there's just one thing is, when I in my job, I do a lot of advice on asset allocation, and I think today is really the day where taking one assumption on equity return, on inflation, on fixed income is not the right approach to think about risk over the long term and asset allocation over the long term, especially when there is big disagreement on central key assumptions such as inflation. So sorry for being a little bit going into jargon here, but I think, looking at stochastic simulations, looking at different ways the world could evolve is really important. Thank you.
Ms. Kholoud, maybe, we've heard a lot about how funds are needing to be more nimble and moving around. What has COVID meant for your fund, and what does this mean for other stakeholders potentially? I think you're on mute.
Yes, I know I'm mute. Thank you, Farah. As I said in my introduction, the thing is that our portfolio is very well diversified, and we had a cash cushion that saved us during the pandemic. Also, working from home was not easy at the beginning because we were not that much equipped, and we had to act very quickly. At the same time, we had to do a very good role at the economy to inject liquidity and help our pensioners, and the Social Security Corporation did many schemes to help. But from an investment perspective, also, we have a very challenging thing that our investments are all locally. And as Karin was saying, now we have to look on more infrastructure, because we have around 70% liquidity. So the liquidity is okay, but it's not looking 2 to 3 years or more, we see that the return will be much lower and will not match as the actuarial study, which is our benchmark. Usually the rate of return is put by is the outcome of the actuarial study, which is conducted every 3 years. So looking forward with the low interest rate, we're not going to have the expected rate of return. At the same time, we have to look more now in infrastructure projects led by usually these projects in the MENA region is led by the government, and we're looking in major infrastructure. Also, if we want to invest more in equities, we're investing more. We're looking into very solid companies with solid and strong financial positions, without looking at the dividends for the short term, because I don't know if you have heard, but for example, the Central Bank of Jordan has issued a decision to not to allow the banks to distribute the dividends for the year this year, and I expect the same for the next year. And 60% of our portfolio is in the banking sector, because it's the most solvent and prudent and strong has financial position. So the dividends and the cash dividends are not the criteria for us to invest anymore. We are looking more on the strong position, on the forward-looking things. So it's also we are looking for international investment, but it's not easy again because we have a limitation by law that in case we want to invest outside Jordan, we have to take the certain approvals of the Prime Ministry and with coordination with the central bank because of the foreign reserves and so on. So, and it's not easy to get these, especially that we have the labor union sitting on the Social Security Corporation board and not allowing, and they see that their money is going outside, they don't see the returns. So it's not easy. It's really a challenge for us. So all of these are challenges that we're looking into it that were not that much before. We used to have very high returns on the bonds, on the cash deposits, and even in the tourism that we're investing a lot in it, in the leasing also, in which the vehicle that we created, that we were able to invest in a lot of government projects. We used to have a very good rate of returns that I cannot see coming in the coming 2 years. But these are all the challenges that are facing us with the pandemic.
Thank you. Philippos, maybe you touched on governance. I know this is something that also Karin was discussing with us. How do you see governance issues, and what does COVID mean for the various stakeholders?
Thank you, Farah. Just before I answer that, just a couple of quick comments on inflation, if I may. As you all know, pension liabilities in the public sector funds in the region are either directly or indirectly related to inflation, directly by occasional increases to pensions in payment, and indirectly because the benefits are linked to the salaries of the citizens. So we see a lot of value in schemes increasing the allocation of capital to inflation assets, such as real estate and infrastructure, in order to produce real returns that create some sort of match to the underlying liabilities. Then on the comment of Karin, I fully agree that stochastic analysis should be embedded in the investment process of reviewing asset allocations, but stochastic models are not rarely designed to fully capture situations like the ones we're going through. So this can be complemented further by careful scenario analysis, and we see a lot of schemes undertaking such scenario analysis that give them an outlook under specific scenarios that could take place in the short term. Now, in terms of governance, I think a lot of the schemes have fared very well in terms of being able to continue operating and implementing their governance processes with regards to investments. As I said, there has been a transition in the region as the schemes change their asset allocation from predominantly home investments to global diversified portfolios. And this journey has been accompanied by a journey of improving governance. We're not witnessing any major challenges, but I think Abdulatif very accurately described how they've been able to cope with the challenges of the COVID-19 situation in being able to continue seamlessly supporting their mandate.
Thank you. Abdulatif, one of the questions that's come through, and it's come through in different versions, and I think it's been answered by some of you, is what is an optimal asset allocation for a pension fund such as yourselves today? And is this going to be a structural, strategic change? I think you've mentioned some of the elements, but maybe for the audience, what is optimal in terms of asset allocation?
Of course, I mean, there is no one optimal asset allocation for all. It will also depend on the liability profile of the institution. And the liability profile will also depend, or the asset allocation will also depend on the funded status of the scheme. So a fully funded scheme might go in one direction, whereas another one that has significant deficits might choose another. Also, the liquidity requirements of pensions will also dictate the amount of assets that are invested in the various asset classes. So, for example, an institution that has a huge liquidity requirement will obviously be capped in how much they can do in alternatives, whereas one that doesn't have any liquidity requirements for 5, 7, or even 10 years will be able to increase its exposure to alternatives and enjoy the liquidity premium associated with them. So the optimal asset allocation will start with the liability profile of the institution, the funded stats that they have in place, and naturally looking at the different asset classes and the return profile of them, and how can one group them in a way that enables them to generate the required rate of return to meet their liability demands will be the optimal one. Of course, one has to take into consideration the different scenarios that we will be in. I think the future has many paths to go through. I think my colleagues in the panel have described several of them: a deflationary scenario, or an inflationary scenario, or a more stable inflation situation. And each of them will have its implications on the different asset classes and how they behave. Obviously, an inflationary scenario will be very tough for fixed income investors, whereas a deflationary scenario might be a better one for them. And so any major decision that is done on the asset allocation will have its impact on the realized rate of return going forward for that institution.
Thank you. And so, Karin, maybe I now pivot to you. You mentioned about ESG, and we know that globally this seems to be a trend and a conversation that has really accelerated from a box-ticking exercise to something that is really at the forefront of many organizations, institutional investors, pension funds. Can you give us maybe a little bit of a landscape of how this differs by region?
Yes, I think it's definitely totally prevalent in Europe. I think about 90% of pension funds, whether they're public or corporate, say that ESG is a criteria that matters to them. It is very important in Canada and in Australia. It is a topic of conversation in Asia and in the States. It's not necessarily very strong there. And I think in the MENA region, it is very important with sovereign wealth funds, but less so from a pension fund point of view. And I think one item that I believe is important is that ESG is not there is not one way of adopting ESG investments, and it's really a journey. And what I have seen with some clients is that you have some who are ESG aware, and what they will do is that they will adopt, ESG criteria in their investment decision making. For example, they may say we do not want to have any weapon producer, or it could be about production of thermal coal, and so this will be really exclusion criteria. And sometimes they may have a small allocation of their assets into ESG funds. An example of this would be, for example, in Australia, the Future Fund, which is really at this stage. And then you can move along this ESG journey, and you can have more engagement. You can have commitment, for example, in voting policies. You can so make sure that you always vote, that you can have more positive screening in the way that investments are made to select best in class in each sector. And you can have more and more involvement in market initiatives and being, signatory of large ESG proposition. So this would be ESG expert phase, and I have an example here in Canada. And then you may have ESG advocates. So here it's not just about having their investment ESG compliant, but it's also really having a very strong ESG reporting activity, having engagement, sophisticated engagement and voting systems, and being part in research and develop innovative partnerships. So just highlight, and also in terms of investment, it's investing from an ESG point of view all across the assets. So I think that it's being ESG aware is a very large, it's a term that may go from one extreme to the other. There are many ways of implementing ESG, and again, I think in this case, Europe is for regulatory purposes really focused on having a very strong ESG across the whole spectrum. But
have we just lost Karin? I don't hear you, Karin. I think we may have lost a panelist. Let me jump to a question on the future of work until we bring Karin back. Oh, Karin, we lost you. Are you back?
Well, I'm here. I can hear you.
Okay, we can hear you now. I don't know if you finished or you were adding something.
Well, I hope you heard me until the end. I had planned on being done now.
Okay, perfect. Thank you so much. Philippos, let me turn to the future of work. What is the future of work? I guess everybody is sitting now living through an incredible pandemic, an era where we are experiencing things that we've never experienced before, many of us in our lifetime, whether in the workplace or at home, the whole working from home scenario, pension funds challenges, whether it's an economic challenge or, as Abdulatif was mentioning, about technology. What is the future of work? Do you have the answers for us?
I wish I could, and I wish I could invest if I had the answers. But I think a key conclusion from what we've experienced is that we are entering uncharted territories with regards to the future, not only of work, but a lot of things. As far as what we're discussing today, it was quite impressive, at least in my personal experience, to see that the disruption, as far as the investment operations were concerned, were minimal. So both from the side of the asset owners in terms of their governance operations and the decision-making abilities, but also in terms of the providers, so the asset managers and the rest of the investment providers, there has been a very quick transition to remote working that has had a minimal impact, given what we've experienced, on the day-to-day operations. So this was a positive outcome of the crisis, and going forward, I will agree fully with Abdulatif that we will retain some of the tools that we've developed. So remote working will be part of our new normal. It would be good to get back to physical meetings every now and then. I don't think that can be fully replaced, given the human nature of interactions. But I think to end up on a positive note, we will be able to retain the efficiencies that we've developed through this crisis, and making our future work more efficient for the benefit of all of our stakeholders.
Thank you. So one of the questions that's coming up is maybe linked to your answer and also to Karin's previous answer is, are pension funds in the region focused on short-term returns, or are they really looking at the long-term impact on society, as well as just meeting their obligations?
If I can start before Karin jumps in, then in our experience, most pension funds in the GCC have evolved their asset allocation to match best international practice. So they're truly focused on capturing the global opportunity set in a risk-adjusted manner. So the process underpinning the asset allocation decisions is in line with the peers that we see in the big pensions markets of the US or the UK or in Australia. So I think they are at that level. There's no short-term focus according to our experience so far.
Thank you. Abdulatif, I'm going to ask you a question on risk. And how are you assessing risk? I mean, clearly COVID has created so much uncertainty and so many different variables. You know, you've seen what's happened to many growth stocks in the markets and the disparity you've seen between growth and value, although you had a massive rotation last week. And I guess when you look at some of these investments, at what level are you looking at risk and how are you able to measure risk in your portfolio?
Sure. So in terms of measuring risk and risk modeling and risk management, broadly it hasn't changed, but obviously the experience we've had added another scenario to the deck of scenarios that we had. Through the pandemic, we saw the sharpest recession on record and then the fastest ever rebound. This is obviously something that not many have anticipated. To see a crash in a quarter and then a recovery in a quarter in financial markets, and investors, if they relied on their past behaviors, would not have captured this very well. And so now we've added this scenario to see how can a pandemic impact economies and markets. What does the impact of stimulus by policymakers do to markets in such scenarios, and how would markets react to that? And our belief is that we might see more pandemics like this going forward. And so it was a very good example to learn from and start adapting some of the measures that we saw in it in our simulations and scenario analysis. Also, the other thing that it made us aware of is how to value and price securities. There are assets that are more prone to the pandemics and its impacts, and obviously these factors were not part of their valuation. So if we look at travel and hospitality, I think their valuations did not incorporate in them, or office space for that matter, and real estate did not incorporate pandemics and their impact on their asset classes. And so now I think there will be a risk premium associated with these asset classes, and maybe a valuation dispersion to other assets that are less prone to such situations. And so risk management broadly hasn't changed, but now we've added more scenarios to our assessment, and now we are changing a bit the way we value things to ensure that we're capturing all risk factors when we're valuing assets. Lastly, I would say that this crisis have also showed us the importance of diversification. And so a more diversified portfolio was able to survive such scenario. It also showed us the importance of liquidity. So more liquid pensions and institutions were able to weather the storm. And not only that, but also rebalance when required. And so less liquid pensions or investors probably were not able to rebalance accordingly and take advantage of what happened in markets during the first and second quarter of this year. And finally, I would say now we are increasingly looking at different hedges to hedge against such scenarios. Now, I'm not sure that there are perfect hedges at this time, and how well they're priced, but naturally, when the pricing of such hedges are available, I think prudent institutions should take advantage and maybe start to adding them in order to ensure that their pensions and portfolios are well equipped to go through such a scenario.
Thank you. I have a question around the funding ratios. How healthy are they in the GCC? And are there any government policies in the public pension funds? And are there any government policies that potentially protect retirees? I don't know if anyone wants to take this question.
Yeah, if I may just attempt, funding ratios range, I would say in the region of 10% to 50% in the GCC public sector pension funds. Even with the highest funding ratio schemes, the challenges that were very eloquently analyzed yesterday remain. Obviously, for the schemes that have lower funding ratios, the challenges are more elevated. So the government policies that will mitigate all those challenges are what was described yesterday, a structured and gradual reform journey that will minimize the impact to a single generation of citizens over a long period. And the earlier that such reforms are undertaken, the less the impact, and people can adjust their retirement patterns and behaviors and expectations accordingly. So this is the only government policy I think that is viable and makes sense.
Thank you. We have a few more minutes left, so I'm going to just go around the table, maybe start with, the screen, maybe start with Ms. Kholoud. If you can tell us maybe one challenge or one opportunity that has emerged during this year that you would identify?
Yes. Before I have a very small comment about the pension scheme in Jordan. When the Social Security Corporation was established in 1980, 50% of the population were under 15 years old. You know, we were a very young generation. And that's why they set at that time the early retirement age as 45 years old. So moving along, many changes has been done to the law to adjust because more people started to retire, and they found out that 45 years old is very young age. So now it's around 52 for ladies and 55 for men. And the retirement age is 60 for men and 55. So to add to Mr. Philippos' point, one challenge and one opportunity. As I said, the opportunity, I have two. First, we were obliged to focus more on infrastructure. We had this agricultural project that we did not think about, but because of the need of the agricultural projects and pharmaceuticals during the COVID, so it was really a very good opportunity for SSIF to invest in and to look at very closely and to see the feasibility of this project. The challenge and maybe also an opportunity now is that we're meeting even the staff within the same building, we're meeting via Zoom. And we're using more electronically. When I joined 2 years ago, I was aiming to reach the paperless office, and now in 2 months we reached the point very easily because of the COVID. We had to work very fast, and now everything is by electronically. We're changing. We still have the legal issue with the signature, e-signature. We don't have it in Jordan, but the government is working on it to endorse it and legally. But again, it was a very good opportunity for us to use the e-channels and the Zoom and so on. And now most of our meeting is saving time, saving us to go and move from other building to other one. So this was, again, logistically another opportunity. A challenge is the investing locally. I reiterate on this point, is that because 99.9% is invested locally. So this is a big challenge for us because the risk in geographical risk and in currency, of course, it's another challenge that we have it. Thank you.
Thank you very much. Karin, we're going to stick with ladies first. And I apologize for the noise because I think there's a lawn mower behind me. Could you give us maybe one challenge or opportunity? And while you do that, could one of the questions that came through, if you could answer it, if you have the answer, we touched on ESG. Is there anyone in the region that is ahead on ESG?
So, well, let me start first with the point about the challenges. I think within the MENA region, but in general, pension funds are, subject of many tensions, especially public pension funds. One of the questions was about short-term versus long-term. I think it's not always negative to think short-termism, or, it's not always positive to think long-termism. You can check whether you're okay on the path of full funding. You need to check at every point in time. So there is an element of validation to see where you are at the current point in time, whether the job you've done is okay. And I think it's the same for every investment manager. You do have systematically this tension between the short term and the long term. You do have tensions, especially with large institutions, between how the power is spread in terms of allocation, whether the people who do the investment on the ground, how much leeway do they have around their benchmark, how much does the CIO have in terms of leeway around the different asset classes, how much is the board defining these constraints relative to the actual individual. And when I speak with very large pension funds actually across the world, this tension of top-down versus bottom-up is very strong, and this is very specific to public institutions, which have to have in place a very strong governance where there's a lot of checks and balances to make sure that things are done properly. And overall, I think that you had questions about whether a pension fund should invest locally or internationally. I think this tension about the purpose of the pension fund within society versus making money for society, which may or may not be contradictory. I'm just talking about tension, is also an item that's a real challenge for a pension fund to balance. And in that respect, if we're talking about ESG, I think that most pension funds in the region have the mandate to invest locally and therefore have an ESG focus in one way. So they all have a role in society that is ingrained within the actual definition of the pension fund. So after I've mentioned all of these challenges, which are just inherent to the fact that these are pension funds, how to solve them. And I think that there is no better way than what we're doing right now, which is getting informed, understanding what others are doing, and raising the knowledge level as much as possible, so that when decisions are made, they're made with all the facts that are available, and being nimble as more is available as time goes by in terms of knowledge, and keeping aware of what is done.
Thank you so much. Abdulatif, maybe I go to you now as kind of the closing comment. And I think between you and Philippos, you have just 2 minutes to cover maybe a challenge or an opportunity that's arisen this year, and how would you maybe potentially carry that forward?
Sure. So a challenge that rise this year is, of course, the collapse in interest rates and yields across fixed income. As pensions, we rely on fixed income to provide us with good income, good diversification to a risky portfolio, and liquidity. Now, with the collapse in fixed income, the liquidity is still there, but unfortunately, the yields are not there, and the diversification aspect has declined. And so, a big challenge now is to figure out what is how to allocate to fixed income. Are there any proxies or substitutes to government bonds? And if so, how would one handle the liquidity and risk profile of such asset classes, and how would they behave with the rest of the portfolio? So that's one of the major challenges that we are trying to address and figure out. In terms of opportunity, well, the world is always offering opportunities. When we saw the sharp decline in Q1 and part of Q2, that made a lot of opportunities available for investors that were underinvested. People who had the ability to rebalance were able to rebalance into better valuations. And that continues to be the case because we are seeing elevated levels of volatility, which means that we are seeing more opportunities to take advantage of valuations across asset classes when the opportunity arises. So that's the opportunity we are seeing.
Thank you. Philippos, maybe I go to you now to touch on any challenge or opportunity that you see from your perspective.
Yes, thank you, Farah. So in addition to the investment challenges described by Abdulatif in terms of the low interest rates and the all-time high valuations on the equity market, when it comes to the GCC public sector pension funds, there is an additional challenge from the liability side because we are talking about the most generous public sector pension systems in the world when it comes to benefit promises. So these challenges coupled together, we believe that allocations, in terms of opportunities, allocations to private markets do possess natural advantages over traditional asset classes. And we expect regional pension funds to pursue further allocations to such asset classes in a careful manner, aligning with their liquidity and liability profiles. I'd like to close the note by repeating what I said earlier as a key message, that investment of public pension funds does matter when it is coupled with appropriate reforms. And it can be a huge success and a legacy for policymakers to drive such reforms that will create sustainable pension systems for their citizens and future citizens in the future. Thank you very much.
Thank you very much. And I want to thank all our esteemed panelists for their insight. We've covered so much ground today, from investment challenges, asset allocation, governance, ESG, the policy reform side, and sustainability. And I think Karin said it very well when, all of this is really about knowledge sharing and bringing your expertise to our audience. And as Abdulatif also said very appropriately, this increased volatility and uncertainty for sure will create opportunities for investors. So with that, I want to thank our organizers, and please all stay online as the audience because the next session is right after this one. Thank you so much.
Thank you.
Thank you.
Thank you. Bye-bye. Thank you.
Bye-bye.